Hey, this is Stuart with the Military Officer Real Estate Investment Club, and today we're going to go quickly over a small apartment multifamily deal that I was looking at about a year ago. This is a 16-unit apartment in Waco, Texas, and 2 of the 16 are 2-bed, 1 bath, and then the rest are efficiencies. So here's just a photo of the outside there, and here's the 2-bed, 1 bath unit. And then here's just an executive summary that I received from the investor that sent me the deal. So the purchase price was $569,900, building class C, location C, and right now it's 100% occupied, right off of I-35 in Waco, Texas. And like I said, 2-bed, 1 bath. There's 2 units, and then the rest are efficiencies for 14 units. Here's the income and expenses that are advertised, but what I always do is ask for actual P&L statements and rent rolls, which he in turn sent me. So here's just the profit and loss statement. This was for the full year of 2015, which I always ask for at least a full year, maybe not even in 2 if they can send 2 years, and then full rent rolls. So what I'll do is I'll take all of this income and expense reports that he gives me, and I'll put it into an Excel spreadsheet, which is here to help me analyze the deal a little better. So this spreadsheet I got from another investor by the name of Lance Edwards. He does a lot of small apartment investing, and I just got this for free from him, so don't want to take credit for it. But what you do is just input all the data here, and I've already gone ahead and done this to make it kind of a quick run through. So purchase price was $569,900. There's 16 units, so it automatically calculates per unit for $35,619. So then I went through and added, put in all of the rents for each of the units to give me a total of $8,900, and then I put in all of the annual operating expenses based off of the P&L statement that was sent to me. So add in all those expenses, and totals up the expenses for about $50,000 a year, which is a total expense ratio per income of close to 45%. So it's not too bad, pretty average. Normally you're looking at around 50% expense ratio there. So that's pretty accurate. There are a few things that we can go over in a second that I noticed right off the bat where expenses aren't really calculated. But just going off of what they gave us, income is $8,900, gross for a year is $106,000. They also said that there was some additional income from coined laundry, so you get a total gross income of $111,000. They didn't include any in vacancies, so based off of the advertisement, you're getting a net operating income of $61,541, which gives you a 10.8 cap rate, which is pretty good. So 2 things that I noticed right away is they didn't do any vacancies. So if you add in 10% vacancy rate, that bumps it right down to an 8.85% cap rate. And I also noticed that management fees were really low. That probably means that they have like a manager on site or something like that. So I'd like to bump that up to closer to probably 10%. So let's just say that's going to be $10,000 a year. So 9%. We'll say that that's a little better for just easy math. So we'll go down here, and now with that added expense here at a 7.77 cap rate, you're going to try to get debt on the property. Most lenders will offer 20% down or 25% down. I just did 20% down, so $113,980. The rest is amortized, and this is a little low. We'll make it 5%. And it was over a 20-year period with a balloon at 5, but amortized over 20. So we're at about $3,000 a month of debt that you're going to be making $3,600 or $36,000 a year. So that gives you a debt to service coverage ratio of 1.23, which you normally want at least above a 1. So going down here even further, gives you a cash flow analysis. So your net operating income is $44,000. Your debt service is $36,000. So your cash flow per year is about $8,100, and that'll give you about $680 a month of positive cash flow after all expenses, and that'll give you a cash-on-cash return of 6.24%. So it is a positive cash flow, but not the best of deals, but it is being advertised as a property that has rents below market. So if you could buy it and increase the rents and maintain the 100% occupancy, you could probably turn this property around and get it cash flowing a lot better. I will note that if you look in the Waco, Texas area for for multifamily deals, the market cap is normally around 6 to 7% from what I was seeing. So if you put that in there, then based off of these numbers, really the value of the deal based off of market cap is quite a bit higher than the purchase price. So that is how I do a quick analysis on a multifamily deal, and hope you guys enjoy it. Hope you learned something. If you are a veteran or active duty service member, any rank or service, please go to themoriac.com and become a member. Sign up for free. Okay, thanks. Hope you guys enjoy.